Most people assume the banking system is stable as long as ATMs work, paychecks arrive, and markets appear calm on the surface. But beneath that sense of normalcy, financial analysts and investors have been paying attention to growing pressures building quietly inside the global banking system. Today we will talk about the quiet banking crisis nobody is talking about in 2025, so before we get started, make sure to hit that like button, also subscribe to my channel. 10. Most banking crises don't start with panic. They start quietly. When people imagine a banking crisis, they usually picture dramatic scenes, long lines outside banks, collapsing stock markets, emergency government announcements, and widespread panic. But the reality is that many financial problems begin much more quietly. Pressure builds slowly beneath the surface while most people continue living normally. Banks still operate, apps still function, and headlines may even appear calm for long periods. Yet underneath that stability, deeper structural weaknesses can quietly grow. And by the time the average person notices something is wrong, the financial system is often already under serious stress. 9. Higher interest rates change the entire banking environment. One of the biggest shifts affecting banks in recent years has been the rapid rise in interest rates globally. For years, banks operated in an environment where borrowing was cheap and liquidity was abundant. Low rates encouraged lending, asset growth, and aggressive investment strategies. But when inflation surged, central banks responded by increasing interest rates quickly. This completely changed the financial landscape. Loans became more expensive, borrowing slowed, and many assets that were priced during the low-rate era suddenly lost value. Banks holding long-term assets purchased during cheap money periods faced growing pressure as the economic environment shifted rapidly around them. 8. Banks are sitting on massive unrealized losses. One of the least discussed financial issues involves unrealized losses inside banking systems. During years of low interest rates, many banks purchased large amounts of long-term government bonds and other assets that appeared safe at the time. But when interest rates rose sharply, the market value of many of those assets declined significantly. In some cases, banks continue holding these assets instead of selling them, meaning the losses remain unrealized on paper unless forced liquidation occurs. The problem is that if enough pressure hits the system, such as deposit withdrawals or liquidity stress, those paper losses can suddenly become very real. 7. Depositor confidence is more fragile than most people think. Modern banking systems depend heavily on trust. Banks do not keep all deposited money sitting idle in vaults. Much of that money is invested, loaned out, or used within broader financial systems. As long as depositors remain confident, the system functions smoothly, but confidence itself can become fragile during periods of uncertainty. Social media, digital banking apps, and instant communication have made fear spread much faster than in previous generations. Today, large amounts of money can move out of banks extremely quickly if confidence weakens even temporarily. 6. Commercial real estate is quietly creating pressure. Another growing concern involves commercial real estate. Office buildings, retail spaces, and commercial properties in many regions have faced major changes following remote work shifts and economic uncertainty. Some buildings lost tenants, property values declined, and refinancing became more difficult due to higher interest rates. Many banks hold significant exposure to commercial real estate loans. If property values weaken further or defaults increase, financial stress inside parts of the banking sector could intensify quietly over time. 5. Smaller regional banks face unique risks. Large global banks often receive the most attention, but smaller and regional banks can sometimes face greater vulnerability during financial stress. These institutions may have less diversification, smaller liquidity buffers, and heavier exposure to specific local industries or asset classes. Rising rates, weaker loan demand, and concentrated risks can place significant pressure on smaller banks, even if the broader financial system appears relatively stable on the surface. 4. Governments and central banks are trying to prevent panic. One reason many people do not hear constant discussion about banking instability is because governments and central banks actively work to maintain confidence. Financial systems depend heavily on public trust, so authorities often prioritize stability and reassurance during uncertain periods. Emergency liquidity programs, guarantees, rate adjustments, and regulatory interventions may quietly support banks behind the scenes. The goal is often not only solving financial problems, but preventing fear itself from spreading through the economy. 3. Technology is changing the speed of financial crises. Banking crises in the modern world move differently than they did decades ago. Digital banking allows people to transfer money instantly without physically visiting branches. Information spreads globally within minutes through social media and online news. This means confidence shifts can happen extremely fast. A rumor, headline, or market event can trigger rapid reactions from depositors and investors worldwide. The speed of modern communication has made financial systems more connected, and sometimes more fragile than ever before. 2. The system is more interconnected than most people realize. Modern banks are deeply connected to governments, bond markets, global finance, real estate, corporate debt, and consumer behavior. Problems in one area can spread into others through interconnected financial relationships. Rising defaults, falling asset values, weaker consumer spending, or tightening credit conditions can create ripple effects across the entire system. This interconnectedness makes modern banking crises complex because they rarely stay isolated to a single institution or sector for long. 1. The real banking crisis. Confidence is becoming more important than stability itself. The deeper truth about the quiet banking pressures building in 2025 is that modern financial systems rely heavily on perception, liquidity, and trust continuing uninterrupted. Because the truth is simple, banks can survive many financial challenges as long as confidence remains stable. But once fear spreads rapidly through interconnected systems, even strong institutions can face serious pressure. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.